Hello and welcome to Fed Tax 101. Today, we're going to discuss whether something is income for federal tax purposes. That obviously is a pretty important question since the income tax law only applies if something is, income. We'll discuss in other episodes when you have to treat something as income and include it on a tax return. But before we get to when, we first have to discuss whether. The basic premise here is pretty straightforward. If you receive anything of value, whether it's money, property, or sometimes even if someone does something for you in exchange for something else, you have to assume it's income that you have to pay tax on unless you can point to a specific reason for it not to be. So, being familiar with the basic framework for defining what's income and what's not income is a key step in making sure you report the correct amount of tax liability, which, at the end of the day, is all that the thousands and thousands of pages of tax law really care about. Let's start with the tax code. Section 61 defines gross income. It says that unless you're told otherwise, gross income means all income from whatever source derived. It then gives you some examples of things that you have to treat as income, including compensation for services, gross income derived from business, rents, dividends, interest, and some other things. Other sections of the tax code list specific types of receipts that are always income as well as some other things that might be, depending upon the facts. So basically, the tax code says if you receive $1, whether it's in cash, property, services, forgiveness of your debt, or other things of value to you, you have to assume it's income unless you can show otherwise. But why? For that, let's go back to the early days of the tax system when everyone was still trying to figure out how the new income tax should work. Our first stop is 1920. In Eisner v. Macomber, the taxpayer had received a stock dividend on one of its investments. It didn't actually receive any cash, just additional shares of stock in a company based upon the number of shares in that company that it already owned. All of the other shareholders got the same sort of dividend. The Supreme Court was asked whether those additional shares were income, taxable as such, under the 16th Amendment. The court ultimately agreed with the taxpayer and said, no, the new shares were not income. Instead, the court explained that at the end of the day, the taxpayer didn't really have anything more than it started with a paper representation of its partial ownership interest in the company. If the company becomes more valuable by operating a successful business, the taxpayer's ownership interest in that flourishing business obviously becomes worth more too. But the increasing market value of the taxpayer stock would only be potential income, and it's tough to pay the bills with potential. The court used an apple tree to illustrate its point. You plant a new seedling, your original capital investment. It may not be worth much at first, but as it grows, you own a more and more valuable tree. But all you have at that point is just potential gain from your original investment as the tree gets larger and larger and its market value grows. Periodically, the tree produces apples. While they're still on the tree, the apples are like the tree itself, something that you potentially might receive value from, but not yet. Until the apples are harvested, they could get destroyed by weather, eaten by wildlife or a little neighbor, or whatever. But once you pick the apples, their value to you is no longer just potential. Instead, it's been realized by being permanently separated from the original investment, reduced to your possession and control. And at that point, you have income in the form of the apple. At some point, you cut the tree itself down and sell the timber, cashing out your entire original investment and allowing you to put the growth in the tree's market value in the bank. That's the same as selling your shares of stock, your actual ownership interest in the income producing property, which at that point is no longer just potential gain. And once again, you've realized income. So the Supreme Court explained that you can have income from either periodic distributions of earnings, the dividends, or by selling your underlying investment itself, the stock. Until you do one of those two things, though, all you have is a larger tree. maybe with some apples that might or might not make you money at some point in the future. In the court's view, the additional shares of stock that the taxpayer received as a dividend were nothing but a bigger tree. As a cautionary aside, please don't take from this simplified discussion that you never have income whenever someone gives you shares of stock. Neither life nor taxes can ever be that simple. Fast forward 35 years. The Supreme Court again was asked to consider the meaning of income for purposes of the tax code. In Glenshaw Glass, the taxpayer had won a lawsuit against another business, arguing that the other business's unfair practices had hurt the taxpayer's own business. The taxpayer had been awarded not only the amount of its lost profits, compensatory damages, but additional damages as a means of punishing the other business for its conduct, punitive damages. The taxpayer and the IRS both agreed that the taxpayer had to pay tax on the portion of the judgment equal to its lost profits, since that amount would have been taxable income had it been earned in the ordinary course of the taxpayer's business. The taxpayer and the IRS disagreed, though, on the treatment of the punitive damages the court had awarded the taxpayer to punish the defendant, as opposed to compensating the taxpayer. The taxpayer said the punitive damages were not income because they had not been earned through its own capital or labor. Instead, the punitive damages were just a windfall that it should not have to pay tax on. The IRS said, well, of course it's income because it's an addition to your wealth, and all additions to your wealth are taxable unless something specifically says it's not, and nothing says punitive damages are not taxable. The Supreme Court agreed with the IRS. The court said the entire judgment was taxable because the entire amount, including the punitive damages, was an undeniable accession to wealth, clearly realized, over which the taxpayer has complete dominion. There are several major exceptions to the general rule that when you receive something of value, you have income, an accession to wealth. We've already touched on the fact that the tax code itself says that various specific things are not taxable as income, but there are others as well. We'll talk about some of these in greater detail in later episodes, but for now, just know that income does not include deposits. What's a deposit? The Supreme Court basically said that something is a deposit, for example, if a customer gives you cash to hold just to secure some sort of future performance. But whether or not you get to keep the cash is up to the customer. If the customer can demand the cash back at any time, for example, by canceling their account, then it's still the customer's money, not yours, so you don't have to treat that receipt as income. You also don't have income if you receive money on behalf of someone else. You're acting as an agent of another person, or you're just a conduit between the payor and the person being paid. You're just passing it down the line, but you never claim it as yours. Finally, you obviously don't have income if the cash is provided to you as a loan. You don't have an accession to wealth because even though you have a new asset, you also have an offsetting liability. The asset and the liability cancel each other out, so you don't have an accession to wealth. There are others, but these are some of the headliners. We'll go into greater detail on some of these topics in other episodes. So, in summary, what's income? Income is an accession to wealth that you've realized. It's real, not just potential, and that you own and control as your own. If someone gives you cash or property, you should assume it's income and be prepared to show the IRS why it's not. That's one of the most fundamental rules of federal tax law. Well, that's it for this episode of Fed Tax 101. Keep checking back for more. So long, everyone.